Okay, the time is now 11:02. I think that's enough dispensation we've offered anyone who's a little bit late. We're going to get things started today. So the first thing to say is thank you very much for your time and attention. Thank you for joining us. This is the second year in which we published the State of the Climate Transition for UK mortgage lenders in 2025. Before you ask, yes, we did try and think of a shorter and catchier title, but in the end we couldn't, and we thought it was important to keep the title the same as last year. So we're stuck with the tongue twister that we have. Beyond tongue twisters, we have lots to share today. We're very, very lucky to be joined by Amy Thompson, Head of Sustainability at Nationwide. Amy's a wonderful person to have on these webinars because not only does she play a very strong role in the formulation of the various different regulations and guidelines and standards as part of her work with the PCAF working group, she's also an excellent example of the execution of those guidelines through her work with Nationwide. So we have kind of a two-pronged approach to the agenda. I'll be talking you through the study, the key insights from this year compared to last, and hopefully warming you up for the white paper, which we'll share after the session. And Amy will go through some practical examples of what's been working for Nationwide themselves over the last 12 months. Before we get into that, just a very, very quick introduction to CAMA for those of you who may not be familiar. We are essentially a leading provider of climate data to a variety of different sectors. This includes the UK government through our work with the Climate Change Committee. It includes a very wide variety of mortgage lenders, from some of the biggest high streets all the way to specialists and some of the smaller building societies as well. We publish two big things this year. First of all, through our work with the CCC, we published the 7th Carbon Budget in February, or at least we supported their publication of that particular document. As you might be familiar or be aware of already, that document plays a very strong role in defining the path to net zero for every type of property in the country. That helps us set annual carbon budgets for residential property. It goes through the costs, implications, the energy and the emission savings, and it answers the other question of how do we prepare the UK residential property for the climate transition. It supports policymakers to do that. The second piece is more targeted. It's not so much around supporting policymakers as supporting decision makers within the mortgage lenders that we work for. And that's what we'll cover today. So today we will cover how mortgage lenders are preparing for the climate transition. This will cover both climate risks and climate impact. So how lenders are preparing for the challenges they may face, and how they're also preparing to play their role in supporting the transition and supporting customers to decarbonise. As part of this process, we benchmark performance against both current and upcoming reporting standards and regulations. We also benchmark progress against other lenders as well, so you can see where you fit in against the chasing pack. We kept the methodology largely the same as last year. It helps us with year-on-year comparative purposes. So we have 5 sections. Plan is where we look at the strength of planning. We cover off some of the governance points as well. Measure, as you might expect, is really about data and targets. We cover metrics and targets, and actions and progress are really around the strategies that lenders are coming through around decarbonisation and how successful they've been so far. So it's loosely aligned with the 4 pillars that you'll see in your regulatory reporting requirements as well. Our objectives of doing so, I mean, there's 4 here. Let's just focus on the last one. It really is the most important. So every single year we publish a league table, which is the most kind of enticing part of the study for many people. They want to see how they rank compared to their peers. But the most important part for us is easily this opportunity to socialize and share best practice, because it's really a non-competing area in many ways. You know, this isn't about product development. It's not about who's best at supporting intermediate relationships. It's really around how you're supporting your customers and your own organization to adjust to one of the biggest challenges we're facing as a civilization, which is climate change. And in that, we have a vested interest in everyone else doing well as well, so we can collectively hit our targets as a sector, as a nation. So it's a great chance for us to share things because we're not really competing. And if you do look at the best lender in every area and consider the impact of doing that universally across the sector, it's easy to see just how fantastic we could be, how quickly we could be moving towards net zero if we all understood how easy it can be to catch up. So socializing and sharing best practice is our #1 priority here, even above the other stuff. Having said that, let's start with some key headlines from the study. And we're going to start with the ranking because that's pretty fun. The first thing we saw, and this was really fascinating for us, is that every single, or almost every single lender has improved. As a sector, we've improved quite dramatically. So this was true, first of all, if you looked at high streets, you see every lender there going from the performance, the left-hand side, all the way through to the right-hand side with that bar. You can see pretty much every lender on that page has improved to some extent. The same is true of building societies, where you cut the numbers. The same is true of specialist lenders as well, except for those who haven't got started yet down the bottom of that list. So contrary to some narrative that we've seen in trade press and wider news about the fight back against net zero, contrary to the opinions of some policymakers in various countries, and even contrary to some of the regulatory standoffs we've seen where perhaps things haven't moved as quickly as we were expecting them to, we have seen lenders dramatically adjust to the climate transition. This is particularly interesting to us because last year we were on a survey as well. And in the survey, the majority of those who didn't yet have a plan said they're going to write one. And you never quite know with surveys whether that's a promise, whether it's going to happen, or whether in fact other priorities will get in the way. So it's fascinating to us to see that actually, yes, lenders have got to grips with this. They're reporting far more than they were the year before. But what are the areas where we can improve? You know, beyond the good news, what are the things that we can jump on and point out as opportunities to address? What we're trying to do here is point out that, yes, we're seeing increases in some areas. So we've gone from 46% of lenders reporting to 85%, which is a massive jump. We're also seeing improvements in scores across the board. There's other areas where the improvement hasn't been as dramatic, it hasn't been as quick. So in areas like data quality, as a proxy for that, we're using the industry average PCAF score, which is 3.5, and we're saying how many lenders are above or below that point. The improvement level has been smaller. So 60% were above average last year, 23% are above average this year. Similarly, when it comes to modeling missing data, we're of course talking about EPC data here. Last year, we said 15% were modeling missing EPC data. Now it's gone up to almost 20%, but that still leaves a data gap of 4 out of 5 lenders. So whilst we made big improvements overall, big increase in lenders reporting, there's still 2 areas where we can work faster. One of those data quality, and the other is modeling missing data and closing data gaps. Point number 3, we looked specifically for this year at climate risk, and we found this fascinating situation that we're referring to as the transition risk paradox, which is trying to explain a disconnect between time horizons and the level of preparedness for different climate risks. So first of all, again, same story, we did see a big increase in overall quality in actions taken by lenders. So 29% were reporting their EPC ratings last year. That's gone up to 49% this year. But if you look a bit deeper, you can see some other opportunities to improve. So if you take, for example, a comparison between physical risk and transition risk, they're kind of mentioned to almost a similar extent. So 58% of lenders will mention some challenges around physical risk, and 54% were mentioning transition risk in their plans, in their reporting. If you dig deeper, though, and look at things like climate scenario analysis, over a third were running climate scenario analysis for physical risk, only a fifth were running climate scenario analysis for transition risk. This is particularly interesting to us because it crops up in CP1025 over and over and over again. The PRA, the wider regulatory bodies, they're expecting us to run far more climate scenario analysis than we currently are. And this is a particular issue when it comes to transition risk, which is kind of lagging physical risk in terms of the numbers of lenders who are acting on that. It gets more interesting to us if you dig even deeper, because obviously the time horizons for these two things are quite different. So if you take as a proxy for this flood risk, we typically look at scenarios up to 2050. For transition risk, we're looking at this scenario by 2030, when some of these more aggressive regulations may come into place. And in fact, for transition risk, when we're modeling it for CAMA, we don't even look at, say, a late action scenario. We look at early action pretty much versus no action, because there's not much else in between. And then again, digging deeper for the 4th time, if you look at the typical share of the portfolio at high risk, again, the situation's not actually that close together. So for physical risk, we're using JBH data. We're looking at the proportion of properties in this country that are at high risk of flooding, and their data point for that is 5.5%. For transition risk, we're looking at the number of properties which will struggle to achieve EPC grade C when you look at the cost versus the size and type of the loan and the size type of the property. And when we looked across all properties we looked at with our analysis before, typically 15% are going to struggle to achieve EPCC. So pulling this together then, what we're basically saying is that, yes, they're both being nodded to within reporting, they're both being talked about. One risk is more likely to be stress tested and to be tested in different scenarios, so looked at more rigorously than the other. And yet that second risk, transition risk, is the one which may impact sooner and may impact more properties within the standard mortgage portfolio. So arguably it's the more urgent and the more important risk to look at. So we found this juxtaposition quite interesting, and that's why this next point is around the transition risk paradox. Rather than just point fingers and say, well, lenders aren't doing this, not doing that, we wanted to give you a very simple case study of how to look at transition risk. The clue may have been into the metrics we had on the last slide as well. Our key question or crew request here is to look beyond EPC rating. So we've got 2 example properties, property A, property B. They're both D-rated as an EPC rating. So which one's higher risk? Well, arguably they're the same. If you look in more detail and look at the cost to C, property B is much more expensive to achieve that. So which one's higher risk? At this point, you say property B. If you look at, say, the asset value, well, property B, it turns out, is worth almost $1 million. Property A is a much smaller property, much lower value. Therefore, property A might be seen as higher risk when you look at the cost to C versus as a proportion of asset value. And look at the details of the loan as well. Again, in this particular scenario that we've kind of labored to make a point, for property B, the mortgage is quite small compared to the value asset. LTV ratios won't shift if you load that cost into the loan, but they will for property A. So again, property A is seen at higher risk. We've used this very simple example to show you how easy it can be to run climate scenario analysis and therefore try to close that gap with physical risk and beyond in light of future regulations. The only thing you really need for this is a very good metric for cost to C. And within this, we are held back a little bit by EPC data. So again, using data to draw this point out, if you look at the EPC methodology for approaching cost to C, they will look at all the improvements the property you can benefit from. They'll average the cost per sat point. They'll look at sat points to C, and they'll add, therefore, a cost to C based on that. This is an industry standard way of doing things that has been used for a couple of years. The average cost to C used this approach is about £10,500. The government publishes the EPC data, but doesn't actually think this is particularly accurate. Their own metric for this is 7,100. What we do when we look at a property is we look at every single property at the property level. We look at the improvements available to that property, and we use up-to-date pricing, not based on the methodology of 2012. And we typically get to a number around about £4,500. So our key point here is, in terms of the flow of the story, transition risk is under-resourced, under-looked at versus others. There is a simple way you can do that, but you need a more accurate cost to see to get there. Beyond the challenges and areas to improve, let's return to some good news here. And so we can look at rates of decarbonisation over the last 12 months. This is a particularly interesting metric because it's been an area of challenge for a lot of lenders around the market. We have lots of conversations with different mortgage lenders. Very few of them are absolutely delighted with the take-up of their green proposition. Very few of them are really reporting dramatic decreases in finance emissions on a year-on-year basis. We're also using an intensity metric here to make it comparable on a year-on-year basis as well. Sometimes we do see big numbers, but it was only because the methodology had changed. We are actually very interested to see some lenders now streaking ahead and delivering substantial levels of decarbonisation on a year-on-year basis. What this actually points to, once you get past the 1% to 2%, is it's not just a change in makeup of their book. They're not just offering loans on A's and B's, but they're actually being able to drive an improvement in the properties they lend on, supporting through, say, increased drawdown or retrofit loans and supporting properties to improve. That's also the case with ecology. So ecology, very interestingly, reported a very large decrease, a worsening situation when it comes to finance emissions intensity. In other words, their lending is dirtier this year than last year. But they very specifically point out they've done that for good reason because they want to drive the change we've seen in UK housing stock. In other words, they are offering loans on poor performing properties so they can also offer loans to improve them. So the reason they've reduced year on year is they've moved away from that loan policy of supporting very green developments, supporting those properties that need to improve, and the loans they offer should reduce this finance emission intensity over time. So even though the situation looks worse, they're actually grappling with the challenge. What this leads us to is this wider question around how far can lenders actually influence their customers to go away and improve properties? How far can you educate them to do so? Again, we've got some very good cases in the market. So we've got some data from a press release from Paragon. On the right-hand side here, you can see that on a year-on-year basis, for the last 2 years, they've seen very dramatic increases in a number of their customers that are taking on loans or increasing drawdown rates in order to improve the properties that they're buying. So big increases in drawdown to improve properties, and also big decreases in decarbonisation. It's a positive success story, and it hints that Paragon have found a way in which you can talk to your customers about decarbonising that makes sense to them and makes them want to act. The kind of point of view here is quite clear. It's illustrated, again, fairly laboriously on the left-hand side. But the key point from us is think about the proposition you put in front of your customers. We have to move away from max retrofit, which is far too expensive for most people. We also have to reconsider whether Fabric First is right for everybody, because houses are very different, and therefore the cost to improve them is very, very different as well. We've got some research we can point to that we did as part of our GHFA grant, which came from the UK government. It was really around how to persuade people to say yes to retrofit. What we found is that they are economically quite rational for the most part. Not everyone is. Some people just want to change their properties because they're happy with the way they are. But for a lot of people, their level of interest will correlate with the strength of the proposition from a financial perspective. So if you think about for the normal homeowner, there's little difference between sort of one cavity wall installation. That's just one installation. It's a category. Don't think about it too much. But the numbers are very, very different because the wall's very expensive, doesn't pay for itself quickly. The ROI, even over a 40-year term, is quite low. And therefore, we didn't see that many people saying they're interested in that proposition through our survey. On the cavity wall side, cost is lower. Fuel savings, also slightly lower, but the payback period over a 40-year term that lasts for us is a lot better. So more people were interested. And lastly, we tested this notion of actually getting a further advance, so getting some money at the same rate of your mortgage to improve, and therefore it reduces the sunk cost of doing so. And yet again, more people said that's actually quite interesting. If I'm spending up for 5 years, but I'm saving money over 40, that's an interesting for me to look at. What was more interesting to us is there's actually an incremental increase in the audience for these two groups. So some people were interested in taking the cavity wall installation, but not a loan. Others were only interested with a loan, and therefore you're extending the reach of that offer. So key point here is, look, other lenders are doing it. We're supporting decarbonisation, so it can be done. Secondly, we think how we go to market with that proposition is really, really important. And if you have different opportunities for different homeowners, that's likely to extend the value of that proposition as far as possible. What we haven't mentioned here is the role of brokers, which is much trickier, but we'll stay away from that for the purposes of this presentation. So that's it in terms of some key insights from the study. We've seen, for example, everyone improving, people doing more, big increases in things like reporting EPC ratings, some particular challenges around data quality, data gaps, and also how we're thinking about transition versus physical risk, and some good examples of lenders starting to decarbonize. Let's look at a little bit of detail around some more kind of best practice examples. To start with, we've got our top 10 rating for this year. Number one across all areas was, again, Nationwide. I found this personally quite frustrating because it's a better story for me if it's change in league table. It's a bit boring when someone wins the EPL for 2 years in a row, for example. But sadly, the numbers didn't lie in Nationwide at top because they consistently do a range of things to a very, very high level. Beyond that, we did see some very interesting movers. So Leeds coming into play for the first time, Just Group, Skipton, Tandem, Metro Bank, they've all come into the top 10 for the first time, whereas Coventry, One Savings Bank, Santander and Lloyd done a very good job of staying here over time. So good news to all those lenders. We did want to do a little bit more and just kind of point out that, as this chart says, size isn't everything. So we looked at the UK finance data on the basically outstanding balances, the size of the back book of different lenders, and we compared that to their overall score, each of these dots representing one lender. You can, of course, see pretty rough correlation between size and ability to deliver on a high scoring transition plan. So resources do matter, and the PRA's point about proportionality therefore does come into play. We want to single out those lenders in the bottom right who did a particularly good job of basically preparing very, very good plans without necessarily being able to access the resources of the larger lenders. So again, congratulations to those lenders. Last couple of points from me. The first thing I want to talk around is, again, returning to this point of, if we did as well as the best performing lender in each area, as an industry, we'd be in a great position. So let's break that down for a moment. I mean, that could be taking the approach that Leeds do when it comes to data. So they've been deploying metadata to remove EPC bias and look at their finance emissions. What this gives them beyond a more accurate read is also a way to track accurately year on year. One of the big issues in trying to understand the pace of decarbonisation is, if your methodology is flawed to begin with, do you then change it halfway through? Do you re-baseline? How do you kind of approach things and get a fair year-on-year comparison? Some of the work we do is actually in re-baselining for different lenders because the methodology they're using up to this point wasn't accurate. By doing so, or by starting with an accurate place to begin with, you are future-proofing your approach, and you're able to see on years to come how you're performing. When it comes to CSA, I don't want to kind of steal too much thunder from Amy, who's about to take over, but Nationwide do a very, very good job at looking at specific scenarios and assessing both their ability to decarbonise and also the level of risk in different ones. On targets, Just Group do the same thing, but they talk specifically around the impacts on their decarbonisation targets. So Just Group have a very aggressive decarbonisation target. They want to reduce emissions intensity by 50% by 2030. Their modelling work looks at different policy scenarios, and so they know with positive policy headwinds, that's things like, the warm homes standard kicking off in a big way, future home standard coming to play as well, government grants actually being spent and heat pump rollout working. They know in a positive scenario, they can actually see their book reducing by 41% without them doing anything. And they therefore got 9% they need to tackle through their own lending policies and through their own plans. What this does is a few different things. So first of all, it gets them away from the fear of we're now responsible for reducing emissions by 50%, which is impossible for anyone to do on their own. Secondly, it allows them to cascade. So they've got 9% to deliver by 2030. That comes down to an annual target, which may then be supported by 3 or 4 or 5 different initiatives. It allows them to put a number against each of those, which is sensible rather than dramatic. And lastly, it supports lobbying as well. So if you're a large lender, you're under a lot of pressure from the government to just give away lots of money to support homeowners to improve. There's an expectation there that homeowners are easy to work with. Whereas in actual fact, as we've found in the market the last few years, that's anything but the case. What this data gives you is a very good tool to go back to them and say, well, actually, we can reduce by 5%, 10%, but the rest needs to come from policy. We need these things to happen at this sort of time frame in order to hit our own targets. And then lastly, decarbonisation. Paragon are out there actually supporting landlords to improve, which is great to see. And they are reducing substantially their level of finance emissions intensity. What we did then is take that emissions intensity and say, well, what happens if the entire industry does this year on year up to 2030? That actually leads to a 49% decrease in emissions by that point. It's obviously a slightly absurd number because to do that, you can't just improve properties, you've got to install heat pumps and everything else. But it just gives you a very good example of what's possible if you can take from the study the best bits of other lenders, combine with the great things you're already doing, and pull together with a much better plan. So hopefully on that basis, you're happy with the insights we've shared, and it's given you at least some food for thought when it comes to planning your climate transition actions for the next 12 months. Okay, one very last slide then. This is the obligatory sales pitch around CAMA. We do a few things and we do them very, very well. One is deliver very, very high quality data. So we basically with the Climate Change Committee work with a variety of different data sets on the EPC to correct and improve those challenges. That means things like our finance emissions numbers are reliable. It means our cost to C is much more accurate as an estimate than the EPC. And it means we can therefore unlock much more sophisticated analysis. We provide a lot of this data via API, so you can understand the climate risk on the properties you're loading on before they get onto your back book. And we also provide a range of other different formats as well. So we deliver reports through a back book. We have a retrofit optimization tool, which we have improved over time, such that it does actually support homeowner decisions to reduce carbon rather than being kind of a nice to have tool. And we support regulatory reporting requirements as well. So that was a very whirlwind tour around CAMA. Anything else you'll talk about, please do get back in touch with me. And at this point, I'll hand over to Amy to talk us through the nationwide case study.
Thanks, Joe. Hopefully everyone can hear me and see me.
Coming through.
Good. So yeah, I thought I'll give a bit of an overview of our approach at Nationwide. A lot of you on the call will know a lot of this, so apologies if I'm going over old ground. But you may not have necessarily read or sort of understood like what we were trying to do in terms of our latest disclosure. So I thought it might be helpful. So if I could go to the first slide, please, Joe. As you'll know, environmental consciousness is a core part of our purpose. We have a very strong purpose Nationwide. Obviously, we're a mutual. We're the world's largest building society and we're the second largest mortgage provider in the UK. Back in 2022, we set intermediate science-based targets across scopes 1, scope 2 and scope 3. And we also published our transition plan, which is sort of a 3 to 4 year strategy about how we were planning on supporting reduction of emissions in line with those targets. I think the key thing to call out for this year is obviously we've gone through quite a large transformative change. We've obviously acquired Virgin Money, and in that process, running up to publishing our latest set of disclosures, which went live in May, we wanted to connect the story at a group level. So we've done our best in terms of those climate disclosures to try to be quite consistent across the group in terms of our climate strategy. We've refreshed our climate strategy. And we've also grouped our targets. So that's trying to be consistent with our approach across target setting across all scopes so that going forwards, we can have much clearer kind of ambitions and progress measures underpinning those. If I just go to the next slide, please, Joe. Some of you may well have seen this before, but effectively this is our climate strategy. So we've historically had 5 pillars towards our climate strategy, and we've now added a 6th, and that's with the focus of supporting businesses in the transition towards net zero. So for those who don't know, Virgin Money have a relatively small business portfolio, but it is targeted very much at small and medium-sized enterprises in the UK. So it is part of our broader climate ambition now for us to continue to support that. They've done some amazing work so far in supporting those transitional pieces, with some great funds and options available for our business customers. So it's really critical that we continue to embed and show support for those going forwards. The rest sort of remain broadly the same. Obviously, we want to support the greening of UK homes. That still remains our biggest exposure nationwide. We do a lot of advocacy work around net zero. I guess given the fact that we are a mortgage lender, we think it's incredibly important to continue to raise the messages around some of the challenges that we face in greening the UK economy. We're trying to do as much as we can internally in terms of what we can control in our own business operations as well to green and reduce our emissions where we can. One of the points I actually wanted to just raise, because sort of Joe alluded to it on a previous slide, is around climate risk capabilities. So we've done a lot of work to enhance our climate risk capabilities over the past number of years, really in line with SS319. But one of the things we continue to do is some climate scenario analysis. And this year, what we did is we carried out some further sensitivity analysis on 2 core scenarios. And what we wanted to do is really stress the maximum impact across each scenario if we were to then effectively run those in parallel, or those effects were to occur at the same time. And that was quite an interesting exercise to go through to understand the potential increases in potential ECLs that resulted from that exercise. And interestingly, still at the moment, and I'm sure it will resonate with a lot of individuals on this call, but the impact of climate change is still coming across as reasonably low across our portfolios. I think we do a lot already internally to manage the risk nationwide, and we have a property risk hub which has been in activity since 2016, managing the physical risk side. But obviously we're very much dependent on policy and government action on the transition risk side to sort of take people on the journey. So that's quite an interesting finding, and we'll continue to obviously assess our scenario analysis going forwards. Next slide, please, Joe. So just to give a bit of an overview, really, I mean, I think I showed this sort of slide last year. It had less on it because we've now got targets across our business portfolio, which we disclose within our TCFD on an annual basis. So we still continue to have Scope 1 and Scope 2 targets, as well as our upstream target to reduce absolute emissions. And then we've got mortgages, which we've extended across the group, registered social landlords, commercial real estate, and then we've got our 4 main business lending targets, which are translated across from Virgin Money. And the thing that I want to stress, and it sort of comes across a lot in our disclosures, is the fact that we're really clear on the levels of control that we believe we have in our ability to progress towards these targets. We can obviously fully control our business operations, where we spend our money in terms of the gas and the electricity providers that we use. We also have partial levels of control over our upstream supply chain, given the fact that we can influence them and can control where we spend our money and with whom. But our downstream activity is obviously very, very limited in terms of our control. And in fact, in this year's disclosure, we were very clear that we aren't going to achieve our mortgages target. We've done a lot of work to analyse the policy landscape and understand the potential pathway outcomes, which I will show you on the next slide. So this slide is in our disclosures, so please go and read a little bit more about it if this is interesting. It has obviously a lot more flavour around how we've approached this and what we've done, but we've done quite a lot of analysis internally around potential policy pathways and outcomes of either committed or potential government policy. So we've looked at some of the key stats and statements that the government have made around their commitments to build more new builds, deliver more retrofit, decarbonise the grid, which obviously has been an enhanced commitment from this new government, and also the heat pump commitment, which I think is fair to say is quite a challenging one, given we only have a few years left, and arguably our assumption is actually pushing that out more to the right towards 2030, whereas the original heat pump strategy was 2028. So it'll be interesting to see where that lands with the revision of the Warm Homes Plan. But I just wanted to talk to you about basically the pathways themselves. So we've done the analysis to understand roughly where we think we'll land in terms of if you know, if all of the policies were to be delivered exactly as committed and in the timeliness or that have been stated, we think we'll land somewhere close to that sort of paler blue block. There is still a lot of wiggle room in that, but interestingly, even if the government deliver on everything and we can enact that, we still think there's going to be a gap to the target that is dictated by science. So that's a really interesting finding. If certain activities within the policies are enacted, we could potentially get to a slightly more stretched pathway. And then there's some assumptions that we've built in around, I guess, the more likely pathway, which is starting to just sort of extend some of those trends that we've seen in the past few years over the coming few years. So if nothing radically changes or moves forward, we're more likely to land in that sort of dark blue area, which, you know, is sort of recognizing some of the trends that we've seen with our emissions reductions over the past few years, which are effectively those dots on that graph. So hopefully that's quite helpful in terms of what is potentially trying to demonstrate, and that sort of led us to conclude that we don't think it's going to be achievable to achieve this target by 2030. But what we do, which is on the next slide, is we do continue to shape and progress some of our work from a transition planning perspective. I don't know whether, thanks, Ray. As I mentioned, we are focused very much on what we can control and what we can offer as a financial service provider. Business operations is a big area of focus for us. We've been decarbonising our business operations since 2012, so we have been on a journey with this. And we are nearly 100% of gas removals in the nationwide branch estate, which is a pretty impressive achievement to make. So hopefully we'll be able to announce that in our TCFD this year. We obviously need to think about what we might do for those Virgin Money branches, because our branch promise has been extended to cover Virgin Money branches. So we do need to think about what that means. But hopefully we've got a really great blueprint on the nationwide side, certainly, where we can leverage and sort of look at what that means for Virgin Money.
Wow. Sorry, we've got loads of time, partly because I speak far too quickly, but just one question there. Is that basically moving to heat pumps, or are you looking at district heating or other sources of electrical heat?
Different types of electrical heat, effectively. So some are heat pumps, some are electrical boilers. It's varying levels, because obviously the differences in branch sizes will depend on, determine sort of the solution that you accommodate, and also just some of the restrictions around planning, around what we're allowed to do. But yeah, so it's just different types of electrical solution that we are exploring, effectively, dependent on the type of branch
good case study
that we can. Exactly. So we continue to source 100% renewable electricity, and that's actually across the group level. I'm sure that'll be familiar and similar with others as well. And I think what's quite helpful in this vein is, because we can control our targets here, they are linked to remuneration, which I think is quite a powerful tool internally, certainly to unlock funding and certainly to unlock sort of focus on these initiatives. So that has been really, really helpful. And then whilst we can't really do much in the mortgages space in terms of really changing the dial, what we have been trying to do is do as much as we can to try and help pivot and help green the UK economy. So we've got a markedly leading 0% interest green additional borrowing pilot. The product's actually been out there since June 2023, so it's been in the market now for just over 2 years. The pilot itself is for around 5,000 customers, so it gives you an indication, the fact that it's still in the market, that the take up has been quite low, but it really is an amazing product. So if we can fill the awareness funnel, then, you know, we can improve those stats going forwards. And then we also have, I mentioned it before, but on the business side, we have Mobiliser Fund, which really aims to change the dial for business customers and support those in doing the right thing from a transitioning perspective. And then just the last couple of things I wanted to mention was our supply chain. So we've done a lot of work with our supply chain, embedding ESG principles into our third-party code of practice. We also have a science-based target schedule, which we ask some of our bigger suppliers to sign up to, which encourages them to publish their own targets and own transition plan. And we also work with EcoVadis. And we invite those who we can to join the platform to just encourage those to declare and talk to their sustainability credentials through that platform, and increase their scores as well, because effectively it's a questionnaire-based system. So hopefully we will see some improvements over time. And then the last thing, again, was just mentioning around the advocacy piece. We think it's really important that we have a voice at the table, and we share our voice with those who are wanting to listen to us as a mortgage provider in the UK. So we think there's a huge role for advocacy and influence, which hopefully across the industry we can lean into more so and encourage even more policy improvements over time. So yeah, that's all I was going to talk to. Appreciate it's a bit of whistle stop, but happy to take any questions on what I've talked about. Thank you.
That's great to hear. Thank you, Amy. And as referenced, it is now time for questions, so the floor is open. And if the tech works better this year than last year, we'll actually be able to see what the questions are and go through them one by one. So please feel free to drop these into the Q&A box. Question to Amy. I love these questions to Amy. It's a great way to start. Did the recently launched SBTi's financial sector net zero guidance affect your transition plan? Or will it?
So yeah, it's an interesting question. It hasn't affected our transition plan at the moment. We follow the guidance of the SBTi, but we don't go through the process of the SBTi. So we'll certainly look at it in terms of that guidance piece. I think what's quite helpful is obviously a lot of the targets is they're being a little bit more considerate of the potential targets that you can set as a financial service institute. And I think if you reflect what it was doing a couple of years ago, it was very binary. It was very much a straight line graph, and it was sort of, that was the number that popped out at the end of it. But I think they're a bit more open to the fact that there is some influence there, there's levels of control there, and there's these alignment targets that they talk about, which obviously can extend far beyond pure play emissions reductions and can focus on things like transition finance and activities which are ultimately going to contribute to the real economy transition. So I think it's a super helpful development, and obviously for those who are sort of signed up to it, it'll be interesting to see how that does help shape potential future transition planning. So yeah, I think it's a really useful tool to have been enhanced.
Thank you, Amy. There's a question for me now from Miriam. At Camera, in your update, you had the banks that are outperforming despite limited resources. Can you explain how the matrix was calculated, specifically what metrics were used to derive the lending and score values, and what factors contributed to the overachievement of banks like Atom, Tandem, and Ecology Building Society? That's a great question. To answer the first part of it first, we use UK Finance's data on the size of lenders' backbooks. That informed the size of the lending, which was the y-axis, and score was just total score. So at the start of the presentation, we talked through our 5 areas. There's a maximum of 35 points on offer. So we essentially looked at the overall size of the lending portfolio versus their ability to score points across the different sectors. And that's what gave us the positive correlation. We had to use a logarithmic scale because otherwise big lenders at the top and everything else was stuck on the very floor. But we did use that just to try and look at, try and find not just some correlations within the data, but also some outliers. And that's where we got Atom, Tandem, and Ecology from. I do think the 3 lenders you've mentioned, Atom, Tandem, and Ecology, they're all outliers in the sense that they're all very, very climate forward. So if you look at the things they publish, Ecology, the clue's kind of in the name, right? So they're going to be green. That's their kind of their lead reason to be, if you like. But Atom and Tandem are 2 banks that are very aggressively trying to tackle climate change, both in terms of the emissions they finance, but also in terms of support to customer, and also again in terms of risk as well. So I think we've just picked up on 3 lenders, which are certainly for their size, perhaps not overall within the entire category, but certainly for their size, they're doing a lot more than their peers. So there's a question from Amy Mason, maybe one for camera, but Amy, just weigh in if you want to. Linked to resetting baselines, how do you avoid this coming across as potential greenwashing? It's a really great question, and the answer really is just transparency. Now, the issue is that obviously every lender we speak to, and the bigger ones in particular, they are extremely concerned about greenwashing, to the point that One thing we always want to do when we get a new partnership is PR it a little bit. It's good for the lender because they're kind of the brokers see it. It's good for us because other banks see it as well. It's kind of a win-win, doesn't cost anything. But when it comes to green, a lot of lenders are very keen to say, actually, we're not going to talk about this because there'll be some kind of a backlash. So even when they try and do something which is green, they'll still get criticized by somebody. The issue we see is that, typically, especially if you're using EPC data, it will overestimate emissions quite dramatically. So there's something we see quite a lot. They take carbon intensity factors from 2012 because the SAP 2012 methodology, which is used, hasn't changed since then. So essentially, when you're publishing your emissions using that data, you're basically publishing the emissions that you would be financing if we were stuck in the past in 2012 rather than today. And in that 13-year time period, the national grid in particular has decarbonised very substantially. We've also seen a more efficient gas grid over time. And so that change in methodology essentially will make it look as if you just reduce your financed emissions, whereas previously you were overstating. So previously, in a sense, you were brown washing. That's the issue that you have to tackle. The only answer to that is A, transparency, and say, look, we did these things for these reasons. It was best in class at the time, but it's time to improve. And that does now give us a reduction, but that reduction is not real. And that's probably the key point to mention in disclosures. The reduction is not a real reduction in emissions. It is a change and improvement in methodology. And you can also look at last year's data or previous year's data using the new methodology, such that you're then comparing apples to apples. So in the disclosures, it should say very transparently, we've changed methodology for these reasons, and there'll be good ones because the previous methodology is flawed. And on a year-on-year basis, we've rerun the data from previous years using the methodology in order to give you a fair comparison. What we shouldn't see, which you've seen from some lenders in fairness, is when you've got one chart which shows emissions last year, emissions this year, which is a line going downwards, which suggests a causal link, and then a little note saying this is down to a methodology change. It's much better to kind of re-baseline, and then you can publish both data points in a fair year-on-year comparative way. That was a short question with a very long answer. My apologies. Apeksha Gupta says, will the slide deck be shared? Yes, we'll share the slide deck. We'll also share a report which goes through things in more detail after this webinar. Another question for Amy. Did you have to reset your baseline or targets with the acquisition of Virgin Money?
Yeah, it's a good question. And actually, we were very fortunate that Virgin Money's targets effectively were set against the same baseline as Nationwide's. So that has been really helpful because, to the point that Joe made, if you're sort of starting from different starting blocks, then it is really difficult to connect. And if you look at our TCFD, actually, you'll see where this is interesting is our upstream target is only currently covering Nationwide. And the reason is because Virgin Money hadn't set an absolute emissions target for upstream. So just given timings as well, we weren't able to redo the baseline for that to connect it together. Certainly something that we'll consider going forwards, but that's just an instance, I guess, where we felt it was more transparent to keep a target more associated on the Nationwide side rather than Virgin Money side, rather than stick the two together. But the rest of our targets hopefully had the same baseline. There obviously are different approaches to methodology, but then to Joe's point, this is where clear transparency around how you approach it and what you're doing. And for us, we published for the first time this year basis of reporting. Historically, we've always put in the notes underneath the tables our approach to calculating our emissions. But this year, due to the complexities of those emissions calculations, the fact that we had obviously business lending and the fact that we do have some different approaches across the group, it is far more effective having a basis of reporting. And hopefully that's effectively what our auditors also assure against. So it gives us comfort that that coverage and that transparency is played out across our entire disclosure suite. So yeah, definitely encourage those if they haven't got a basis of reporting that and they're worried about the amount of notes that might be underpinning a table, because it does get pretty intense, and ultimately there is a risk sometimes that these data tables take up a tenth of the slide and the rest of the notes explaining what the actual data is doing, to consider a basis of reporting.
Yeah, it's certainly a lot of work. But hopefully through the course of this presentation, we've given you reasons, not just to want to improve for the sake of doing so, because it's more accurate, but also because it does unlock new opportunities. So in other words, the more accurate you are, the better your targets can be, the more sensible they can be, the better you can cascade, etc. So hopefully it's a battle worth fighting. Unless there's any final questions, we'll leave it all there, give you about 15 minutes into your day. And all I've got to say is thank you very much for joining. It's been a pleasure. And thank you especially to Amy for joining and talking us through Nationwide's approach as well. Have good Tuesdays, everyone. Thank you very much. And we'll say bye as well.
Thanks all.
Bye, mate.